All right, next question comes from Nikki. My husband and I have always invested almost exclusively in our IRA accounts, maxing them out each year, and have been focused on solid dividend-paying stocks so that they can compound over time and we can use them to supplement our income in retirement. However, due to a promotion for me and a new job for him, it's likely we will be right at, if not over, the income limit for 2019 to be able to contribute to an IRA. We are hesitant to invest in those same stocks in a regular brokerage as it's not as tax efficient. I've never done any real research on any non-dividend paying stocks since that was never really our strategy. Can you point us in the right direction when it comes to investing in non-dividend paying stocks, or at least how to invest in a regular brokerage in a tax efficient way? More tax talk.
All right.
Ross loves it.
I do. Okay, so the first thing I'll tell you is that no matter what you're making, you can generally make an IRA contribution. And it may be non-deductible, so you may be earning out of that deductible IRA range, but you should be able to still make a non-deductible IRA contribution if you choose to. But let's talk about investing in a taxable brokerage account, because I think this is something that people miss a lot. I see a lot of investors that come to us and they're getting ready to retire and it's all IRA money or it's all 401k money, because that's been the easiest place to do their recurring savings. A taxable brokerage account is actually a pretty tax efficient place to invest. You get a couple of things that work for you. Number one, if you buy a stock and it goes up and you've held it for more than a year, you're going to be paying capital gains rate on the gains, not your income tax rate. So even as your stocks go up in an IRA, ultimately someday you're going to need to take money out of that and you're going to pay ordinary income taxes on all of that money coming out of a pre-tax IRA, where I think you actually get a really nice benefit that it is an attractive tax rate when you sell a stock for a gain in a taxable brokerage account. Number two, there's two different types of dividends that can be paid. One is a qualified dividend. The other is a ordinary dividend. And the ordinary dividend is going to be taxable at your income rate right now, but a qualified dividend is giving you the same tax preference that a long-term capital gain would. Here's the bottom line for me. We've got a saying, don't let the tax tail wag the investment dog. If you have a company that you think is an attractive overall total return strategy, that's a great company to own, whether it's going to be in an IRA or not. You can, from a tax location perspective, you could say that a non-dividend paying stock may be a little bit more efficient in a taxable brokerage account. But ultimately, if those are the companies you believe in, I'm not going to tell you to change your strategy. But my personal favorite companies, things like Amazon and like Alphabet and Google, those are not dividend-paying companies. They are growth stocks. I think there's a lot of research that you can get to in terms of what growth stocks may be appropriate for you. And that's something that I think you should at least explore, but don't necessarily feel like you have to change your strategy just to invest in a new account.